Yo, what's up guys? Welcome back to the channel. In this video, I want to talk about McDonald's stock. I got a lot of good news I want to share with you guys about them. They're actually a hidden AI play with all of their machines. I'll talk about that a little later. They're also a dividend stock that actually has a lot of room to raise their dividend. They're a huge company. Like I said, they're worth $180 billion. They're known all around the world. This is a world recognized brand, and they're literally trading at a forward PE ratio of 20. So this company is trading at a very, in my opinion, cheap valuation. None of this is financial advice. Don't buy or sell McDonald's because of this video. But I just want to share with you all of the statistics that I'm seeing and that I'm very impressed with. I even got on the McDonald's shirt right now. I used to work there. I'm 20 years old. So, hey, don't forget to hit the like on the video. It really would help me out a lot. But we went from working at McDonald's to owning McDonald's because I own one share of McDonald's, believe it or not. But anyway, let's actually dig into the juice of this video. I want to share with you the dividend history real quick. So right now they have a 2.7% dividend yield, but look at the dividend growth that they have. In 2020, their dividend was literally $1.25, and now it's $1.67. So that's very impressive. And let me show you why they actually have a lot of room to raise that. So remember, their dividend costs $1.67 every single quarter, and just in earnings per share, which is EPS and net income per share, it's up 8.45%, but that easily covers the dividend. And that's just the net income. We can also look at the free cash flow, which is the free cash flow per share metric, which is my preferred metric to look at from a dividend payout ratio. It was $3.31, which of course well covers the $1.67, and so does the EPS. And let me actually break that down for you. Let me visualize the number for you. So look, they made $1.93 billion of net income. This isn't free cash flow. They made more free cash flow. But the dividend cost $1.21 billion from this. So they actually have a lot of room to raise the dividend. But let's actually look at it from a free cash flow point of view. So the stock has been falling recently because look at this. Year over year, their free cash flow was down 1.27%. It was $2.39 billion. But remember, the $2.39 billion well covers the dividend. And remember, since they have so much leftover free cash flow, what are they doing with the rest of the money? Well, they're actually buying back a ton of their own stock. They're nearly buying back $1 billion every single quarter. Like, look in the three most recent quarters. This company loves buying back their own stock. You see, look, they used to issue shares. In 2021, they were issuing shares. Now they're buying back their stock like crazy, which I love to see as a shareholder. We can also see that they're buying back debt. You see, they paid off $1.62 billion of debt. Let me show you their long-term debt position. The debt is literally only up 0.44% year over year. So the debt is not a concern at all, especially when they're making over $2 billion of free cash flow a quarter that they could use to pay off the debt if they needed to. So they're in a very financially stable condition. So yeah, since they're doing all those stock buybacks, we can go to their total common shares outstanding, and we can see it's down 1.29% year over year. So you literally own 1.29% more of the company, which is a 1.29% non-cash dividend yield. So on top of the nearly 3% dividend yield, you're also getting that non-cash dividend yield in the form of stock buybacks, which I love to see. And if we head over here to their balance sheet, most people will say this is very concerning, but this is actually what all restaurant stocks, assets to liabilities looks like. Like, let's go to Starbucks, for example. Oh yeah, and I want to talk about Krispy Kreme a little later because McDonald's has some partnership with Krispy Kreme that I don't know if it's going through yet. But yeah, Starbucks is even worse. They have a lot more liabilities than assets. But yeah, they're not really worse. Starbucks is completely fine financially, but I'm just showing you that this assets to liabilities ratio is completely normal when it's over 100% like this. Oh yeah, and here's Wingstop's. Their assets to liabilities ratio is over 200%, but this stock right here, I mean, you can't short this company. They just keep hitting new all-time high after all-time high. And McDonald's is not joining the rally. I guess Wingstop and Chipotle are stealing market share from McDonald's. Or maybe the prices are too high. There's a lot of troubles. There is bearish news. I always want to be aware of the bearish news, but I think all of that, in my opinion, is priced in. And at the beginning of the video, I mentioned that McDonald's was a hidden AI play, and let me quickly explain what I mean by that. Have you ever gone inside one of the stores and seen those machines where you place your order in? Well, in some places, like a lot of their stores, that's the only way you can place an order when you go inside the store. There's no human to talk to, so the only people they hire at the stores are all the chefs and the cooks, and then the person who worked the drive-thru to hand people the food, take the orders. You know what I mean? So McDonald's really is cutting down on the amount of workers that they need. And for another company to build out the technology, like ordering on a machine like that, it's pretty difficult. So McDonald's actually has a moat to them. They're, of course, known all over the world, but let's actually show you some of my favorite stats about the company. So they buy back 1.31% of the company. So the dividend payout ratio is only 56%. Remember, I showed you that just a minute ago with their free cash flow, but they have a free cash flow yield of 3.97%. This is way above Apple and Microsoft, but those are not in the same industry at all. So, of course, they got the forward PE ratio of 20, a price to earnings growth of 1.93, which is very fair. That's under 2. I'm actually shocked. And one of my favorite metrics down here, the return on invested capital. They have a 20% return on invested capital. Here's their margins down here. For a restaurant, all right, so for a restaurant company, they have gross margins of 57.9%, free cash flow margin of 28%. So, these are some really good margins in my opinion. Here's a little more about their free cash flow of $7.27 billion in the trailing 12 months, which is a lot of free cash flow. That's what you do a multiple off of. Here's what the analysts are saying. On the very low side, the stock should be $287, which is an upside from today of 14%, which is really good. There's a lot of analysts covering McDonald's. This is a very popular stock, but I want to show you more importantly the EPS forecast, because this is how much EPS they made in 2023. We can see the low and the high estimate for every single year, but I want to go out to 2028. So the low estimate, we're going to take the lowest of low estimates, so 17.45. I want to pull out the calculators. So we want to do 17.45, and McDonald's today is trading at a 20 times forward PE ratio. So let's do the same thing and trade it at a 20 times forward PE ratio, which is really cheap. That means on a very low, this was the lowest EPS estimate on a very low, very conservative multiple of $349 per one share stock price. And today, McDonald's is $250. So a very low, very, very conservative share price, in my opinion, not financial advice, is $350. So that's kind of how I broke that down. We can even go on the high estimate and do $20, $20.26. Let's try that one. So $20.26, but let's go with a little higher multiple. Let's do like a 23 times multiple. That means a $465 stock price. So that's how I do my analysis. If you like that, make sure you hit the subscribe button. And if you leave a comment, I'll make sure to respond to every single comment. And for those of you that are curious, I'll give you a quick update on my Robinhood stock portfolio. We're $13,300 roughly. So here are all the stocks that we own right now. Here's how much equity I have in every single company. And here is my total percentage change from every single stock. And here, our largest holding up here, it goes from largest to smallest. But this company right here just keeps going up and up. And it's just incredible. All these stocks, I don't plan to sell them or change them. The only stock we're down on is Salesforce, so I guess we'll see how that goes. They reported some pretty bad earnings according to Wall Street. I thought the earnings were really good. They make more free cash flow than Coca-Cola. Salesforce is cranking out the free cash flow. But anyway, yeah, look, at Meta and Google are down almost 2% today. But if we head over here to the past month, 3 month, it's no big deal. We actually have a dividend coming in from Meta of $1.50. I own $1,500 worth of the stock, and I'm getting $1.50. So $1,500 gives me $1.50 every single quarter. And actually, I got paid from Google yesterday. Google paid me $1.40. Now I'm just ranting. Anyway, hope you guys have a great rest of your day.